Moneycontrol and Aditya Birla Sun Life Mutual Fund present Sahi hai Pathshala.
As humans, we are always on the lookout for choices and are also spoiled with choices. The simple case of investments in mutual funds, well, there are an array of funds to choose from to meet different goals in life. Given this wide variety of mutual funds, we at Moneycontrol.com have instituted a brand new series, Sahi hai Pathshala, in association with Aditya Birla Sun Life Mutual Fund to help you strengthen your bonding with the right fund by making you understand the nuances of various kinds of funds. Hello and welcome to this brand new series. I'm Sumaira, Abidi, and joining me today on the show is Mr. Balasubramanian, MD and CEO of Aditya Birla Sun Life Mutual Fund. And today, we're going to be talking about how to create a mutual fund portfolio that aims to enhance returns in a bull market while managing risks in a bear market. So, Mr. Balasubramanian, thank you very, very much for joining us in this endeavor of ours. The first question that everybody wants to know is that the number of schemes is always increasing, right? As of last count, there are a shade under 1,300 schemes available.
Correct.
Now, one is that is there a requirement for this kind of choice or for the universe to be this large? And secondly, if yes, how does one navigate it? How do you choose a fund?
So, I think we have to look at the whole mutual fund product offering from a different angle. The mutual fund will keep coming with the new schemes, with the new theme attached to it, and ultimately they look at innovation while offering the product which can suit actually specific solutions of the customers, or it could be something which is more adaptable, which is more suitable in today's context and so on and so forth. That's the way I think mutual fund products are being offered. We will definitely have more number of products given the fact that I think over a period of time, the mutual fund industry has done a great job in categorizing each of these schemes as to this scheme is meant for what kind of investment on the basis of investment objective of the scheme and so on and so forth. The categorization schemes also come both on the equity as well as on the fixed income. Therefore, from a consumer point of view, investors point of view, while of course you get lost on 1,300 schemes or 400 schemes that the mutual fund industry offer, every player will also offer a similar product. Other than that, we all must understand Aditya Birla Sun Life Mutual Fund will have a presence in every category. The same way, other mutual funds also will have a presence in every category. The question is how one should go about building their portfolio. And that's something from investors' point of view is like having identified you have 4 asset classes. I think the way we have defined Aditya Birla Sun Life Mutual Fund, every customer needs are being met through the mutual fund schemes for different purposes by way of categorizing the category itself. There is a liquid fund which takes care of your like a savings account. You can actually park your money, don't do anything of this money, can continue to remain in parked actually in liquid fund. That is called as savings needs. Then comes the equity. Equity is the larger component of every customer needs today that creates a longer term wealth. The longer term wealth can be for different purpose. Somebody actually has got excess money, he wants to put the money into better use to create long term wealth. Somebody does not have big money but wants to actually secure his future by way of investing in asset classes such as equity, such as real estate and so on and so forth. He wants to build his future brighter by way of choosing equity scheme. That comes with wealth creation. That is the larger component of the allocation that we make. Then the fourth component, which is of course is the tax planning. If somebody has got actually paying a lot of taxes, or somebody wants to save some tax in order to increase the savings, then the ELS schemes come. That's why we have categorized the entire category. And within that, the large component of the portfolio is always goes towards equity for simple fact that most of the investors in the country can actually access the bank deposit and so on and so forth. But at the same time, we also have to access the equity market through the mutual funds for his future needs by way of making him more secured on his wealth creation and so on and so forth. That comes an equity component. And within the equity component, if you see, there will be of course multiple variety of schemes. Something will focus on large cap, somebody will focus on mid cap and multi cap. That will always remain. But within that is always there's always a rule of the game, which every money manager globally, a seasoned money manager follows. We as a money managers, when we construct the portfolio, how do you approach the portfolio constructions? There is a methodology which I think everybody adapts. It's a globally set standards which is called core portfolio versus the satellite portfolio. The core is something which is I think very important for as is important for the portfolio manager, the core is something which I think is extremely important for him to decide which are those core can be. Core cannot be everything that comes in your way. Yeah. Core has to be something which will sustain over a period of time in delivering a return, maybe 15 years or 20 years, 30 years. That investment need not necessarily be disturbed just because you are seeing the market volatility. At the same time, the investment continue to deliver participation there, broad market equity that we normally have a high hope and optimism. That's something should also help him participate. That's why I call it the core portfolio. Therefore, while the education, as an education that all of us have done extremely good job in making investors aware about investing through the SIP for the mutual fund, and within that, how do you go about building your equity component of our portfolio? That is the thing that we are making an attempt this time around our the investor education program.
But you know, the place where a lot of investors go wrong is that either they're chasing returns, so therefore their portfolio becomes too aggressive, or they're trying to protect their capital, so in which case the portfolio can be overly conservative. How do you strike the right mix in terms of fund selection so that you maximize returns when the going is good, but you have downside protection when there is a bear market?
Correct. I think from a construction of portfolio point of view, the objective has to be generate longer term return by way of staying invested, and within that I have to choose which will give me a broader level participation. At the same time, I need to also choose as part of my portfolio which will take care of the worry that is there with me as an investor, that where should I go and put my money, whether the market will come down, whether the market will go up, or the valuation is right, and so on and so forth. We are trying to actually find an answer. Many of the questions for which you don't have an answer, but at the same time we all make an attempt to actually find an answer to it, and therefore look at constructing the portfolio. And in order to remove this worry, the way we have thought about the core portfolio should always be done, there has to be some participation in the broader level market participation by owning companies that are the leaders in the respective sectors or in the respective the business in which they are operating. That is, they call the frontline companies. Basically, the large cap oriented companies, they remain a leader, they show the way for the entire market, they show the way for the business in which they operate, and so on and so forth. They become actually a core part of your portfolio. Therefore, large cap oriented funds could form actually part of the larger allocation in the portfolio. Then comes actually the question about, okay, now I have made these allocations, but I always worry about whether mid cap, large cap, multi cap, all of that got this question mark in our mind, and knowing very well I don't have an answer to it. At the same time, money manager actually does his own effort to make and put an attempt to ensure that he actually straddles between large cap and mid cap and small cap in his portfolio. Therefore, he keep moving his allocations depending upon where he sees more money can be made. That comes to the flexi cap strategy. They call it the flexi strategy. Therefore, that comes actually the second component of the allocations. Then third comes actually is the market will always be driven by euphoria, emotion, valuations, and at times valuations is something everybody is worried about it, but at the same time other two factors also driving the market. So the money manager will always take a call whenever the market become excess in terms of valuations, or maybe the market is actually become irrational. Then normally speaking, from money manager's point of view, he turns bearish, therefore he reduces the exposure to equity. And whenever the market he thinks actually it's a great market to buy for a variety of reasons, including valuations, and gets comfort on valuations, then actually increase exposure to equity. That a common man cannot do that. So that's why I think the balanced advantage fund is something which actually make an attempt to address this issue of customers. Therefore, this comes the third component. We believe that these three components of your core portfolio, assuming everybody is able to build, I think you are able to build portfolio that actually give you broader participations. Therefore, that becomes one of your core portfolio. Second is market move up and down on various market cap that again worry. You leave it to the money manager to decide, therefore, flexi becomes one of your core investment portfolio. Then comes is actually the volatility of the market on base of the valuations, which you want to take the call, then comes the balance advantage fund. Our own belief is on the basis of this analysis over a period of time we have done that somebody has made an investment of this kind of component, then naturally the experience for the investors over a period of time, it's relatively better than what you would have done actually on your own, move from here and there and trying to figure out which scheme to choose and so on and so forth. And so breaking your head on this, let the headache be given to the money managers, let the core portfolio be created for the investors.
So you have launched something called a pro portfolio, and I love the tagline, mutual fund sahi hai, par ek kafi nahi hai.
Correct.
So how much is enough? You know, how much diversification is too much, and therefore, what does a person limit it to, and what is the thought behind this pro portfolio campaign?
See, the pro is actually again coming from the fact that how do I actually help investors to choose their core portfolio which they have to create, and instead of dilly-dallying, instead of actually moving away from market volatility and trying to time the market and so on and so forth, how one should go about building your long-term portfolio. So, that is why I think the pro investing as a concept is coming on the back of that, on the basis of our own internal research and understanding and analysis that is done over a period of time, that how the industry also is building their own the size of the equity by way of building the market. I think if you look at the large component of the assets under management would come from these three categories there, which is what we also believe that from a customer point of view, investors point of view, they need to have a presence in this. That is why we came with the pro investing as a principle. And within that, of course, the diversification comes. Normally what happens is the investors end up choosing one and they look at diversification through various mutual fund schemes. That is one of course one way of doing it. But given the fact that we as a mutual fund offer all product in the respective category, then first and foremost you have to fulfill your diversification within the same fund within you are operating. Because one, it will have a ease of transaction, it will have a better monitoring or mechanism that you can build. At the same time, your servicing requirement whenever is there, I think you are able to actually monitor much better and many advantage that you will get. While of course building your diversification within the same fund houses, of course you can also choose different money managers of different funds for them to choose. It's not the question of whom do you choose, the question is how do you go about building the core portfolio is very important. That is why our pro investing is all about.
Okay, so you mentioned this combination of large cap, flexi cap and a balanced advantage fund, right? So the next question that a person wants to know is that how do you allocate between these three? Is it like a sort of equal allocation, because flexi will also have a large component of large caps, a balanced advantage will also have a large component of large caps. So how do you decide how much weightage to each?
Yeah, I think it's a very good question, Sumaira, in the sense that how the market behaves. See, historically, if you look at the broad market, I am talking about the large cap companies, which is largely you can say Nifty oriented or Sensex oriented. That is why I think most of the large cap name would come. So, that gives you say certain return over a period of time. In general, anything which is get diversified beyond a large cap and look at opportunities, finding winners to be part of the portfolio, so that it can generate alpha in the portfolio over longer term, which is the mid cap and small cap. If we are able to seamlessly move between large cap and mid cap and small cap, they generally tend to generate a return over and above the large cap funds by 1 or 2%. These are historical. I am talking about the longer term. You should not actually measure the success on the basis of the 1 or 2 year or 3 year kind of performance over a long period of time. And then same way, if you look at it from a risk management point of view, I think the balanced advantage fund is actually brings in two elements. One, of course, takes away the worry of looking at the market volatility, basis which I think you are making investment. That's something the money manager takes care. But since this comes actually in between, it generally tend to generate little lower return than the large cap, but it gives you more stability. Because the money manager takes care of that. That's why if you go by that concept, purely on the basis of the expected outcome that could come on these funds over a period of time, our own belief is a large component of your say 100 rupees assuming you have, and that's what you actually allocated for an equity, then at least about 50% of the money could be allocated to the flexi cap. Then comes the equal weight for the large cap fund and balanced advantage fund. Okay. At the same time, somebody is extremely conservative. I don't care that where the market is going to go, but I want a little bit of more safety. Then he can actually allocate the money more towards the balanced advantage fund and then large cap and then flexi cap. That I think that any investors can actually choose depending upon his risk appetite, depending upon his expectations. But one good thing that I think everyone should remember, having a high expectations and build this portfolio may or may not give the right outcome. Therefore, have a moderate expectation, build this portfolio can give you reasonably good expectation over a period of time.
Now, the pure equity schemes, right, which is flexi cap or large cap, here the motive is obviously return maximization.
Correct.
The balanced advantage fund, and many people have rightly said that the objective of this scheme is not to provide you with performance, but to give you capital protection in the bad times, right, to handle volatility well. And this is the only one of the three which will have a debt component as well. So is that the downside protection that you were talking about?
Yes, exactly. See, the moment you say balance advantage fund, it doesn't go too much heavyweight on equity unless until they see there is a great time for a one to increase exposure to equity. Then comes the fixed income acts as a cushion in the portfolio. It will not necessarily protect your capital. I think over a period of time, it can actually give you a better experience given the fact that it has a good mix of equity.
Lesser sleepless nights.
Lesser sleepless, correct. And fixed income component also it takes care of it actually cushion the portfolio in order to reduce the volatility. That something has actually come for the conservative investors. Somebody even choose 100% of the money to invest in their schemes, and there also one can choose it depending upon, as I mentioned earlier, what's the kind of risk appetite that one may have.
Absolutely. Sir, pleasure speaking with you. Thank you very, very much for joining in to talk about this very important subject of how to actually create a portfolio, because a lot of people may know in theory how to do it, but to have practical experience always helps. So thank you very, very much.
Yeah, thank you, Sumaira, and thanks for having me part of the show.
Absolutely. Thank you so much. So with that, we're going to wrap up on this episode. I hope you found this informational. Thank you very, very much for watching.
Moneycontrol and Aditya Birla Sun Life Mutual Fund present Sahi Hai Pathshala. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.